Okay, very good. Well, we're so
All
grateful to
right, so
have
can you
Todd
see my
Churchill here
screen?
with us.
Oh, thank you.
Yeah, we can see your screen just fine. So Todd is the founder of multiple grass-fed forage finished businesses, and he's going to be speaking to us a little bit on the principles of enterprise accounting. What I muddled through yesterday and trying to explain to it, take that, and he's going to explain it with a little more clarity. So yesterday we kind of went through the basic business model using what they teach at RFP, Ranching for Profit, and the Savory Institute, Todd. We didn't really get
Hmm.
into enterprise accounting. We just talked about, okay, here's the ways that you can improve profitability by lowering overheads, increasing your gross margin, increasing your turnover, number of units sold. And we kind of left it at that. And I'm grateful that you're able to fill in the gaps and kind of bring this full circle. So in our group here today, we've got individuals that are full-time, full-scale farmers and ranchers, some that are just starting out, and some that are just ag enthusiasts. But your message is going to be absolutely applicable for all of us, no matter where we're at.
Sounds great. Thanks for having me. Um, for those of you that don't know me, I've spent most of my life, my career is a mixture of accounting, being a part-time chief financial officer for food and ag businesses, and all facets of the cattle business, from seed stock all the way to selling grass-fed beef with the first large-scale nationally distributed grass-fed beef brand called Thousand Hills Cattle Company. I grew up on a farm with a 500 head feedlot and some feeder cattle in near Moline, Illinois. My dad's been addicted to cutting horses his whole life, so we also had cattle on pasture that we could use to train cutting horses with. That was a whole lot more fun than driving a tractor to me. So I went to college for accounting. One of the things that is a really core principle in my family is that land ownership is a way to preserve wealth and pass it on to future generations, but it is not how we fund our lifestyle. Everyone is required or expected to get an education that allows us to have a profession, and uh, and then that allows us to work on our ag businesses as side businesses without depending on them to pay our bills or provide for our personal standard of living. And that's it's really a multi-generational, long-term approach to really understanding how ag works in reality. It's a great investment of dollars that are earned in other ways. Um, so I grew up with that philosophy. My dad's an attorney. We own a small ag bank. We have farmland in Illinois. We have a pretty large ranching operation in central Oklahoma, where we train cutting horses and run about 400 pairs. I went to Minnesota for college and never left. I liked it up here. Uh, Met my wife here, and we have had a farm just south of the Twin Cities for the last 25 years. I left public accounting after a couple of years and started a consulting practice as a part-time chief financial officer. Had a really great life, no debt, no stress, no employees, lots of time off. And then in 2002, one of my good friends who was a very successful physician in the Twin Cities, probably the most innovative physician at that time, was prescribing grass-fed beef to all of his heart patients, and he and they were frustrated by the lack of quality in what they were able to get, and they didn't want to have to go drive 2 hours and buy it from a farm. And when you buy a whole animal, sometimes it's good, sometimes it's terrible. Now you get a freezer full of beef that nobody wants to eat, but you feel like you can't really buy more until you eat this up. And he convinced me to start what I thought was going to be a little grass-fed beef company. And without really having a good plan, 3 years later, I was $600,000 in debt. I was having a great time. It was way more fun than being a CFO, but I didn't really start with a clear financial plan. It's kind of a case of the cobbler's kids that never have shoes. Um, I didn't do a good job of following my own advice, and so uh, I created a business that I had to scale up quickly because I needed the volume in order to service all that debt. And uh, One thing led to another. We grew really quickly. By 2015, we had 12 million in sales. Half of that was with Target. Target was the retailer that really gave us a national presence. And then Target went through some challenges. They had some changes in leadership, and all of a sudden we lost that business. And that my Thousand Hills wasn't big enough for my business partner and I to continue to operate together. So he decided we decided it was best for him to buy me out. He's continued to own it and operate it and has done a great job running it. And I went back to my consulting practice. 3 years ago, I merged that practice in with Clifton Larson Allen. We're the eighth largest CPA firm in the country. I'm after 25 years of working for myself, I wasn't sure how I would adapt and adjust to working for a large organization that has 9,000 employees and 130 offices. But I'm having a great time. I have access to resources and people at CLA that I never would have had access to as a soloist consultant. So my focus now, as I lead our outsourced accounting group at Clifton Larson Allen, and that means part-time CFOs, controllers, and bookkeepers. And one of the things that we're really focused on is teaching our ag clients how to use enterprise accounting instead of just throwing everything together in one bucket and doing cash basis accounting, which is really all you have to do to get a tax return done. And so if you're working with your tax CPA, that's oftentimes all you get. But you can't run a business. If I owned your business, I would want to know things about how much is each enterprise contributing in gross margin towards the overhead. Well, cash basis financial statements that don't have things broken up by enterprise can't answer that question. Which enterprises should we do more of and which should we do less of? Should we make our own hay or should we buy hay? Are we really making more money with our own calves? Or how much economic advantage is there to using home raised calves versus purchased calves? Everybody likes to talk about that. Very few people have data to justify and support their emotional decision. And that's the way most of us in every industry, but in ag in particular, we make emotional decisions. And then we try to find a little bit of data to justify to ourselves and our spouses and others, family members, our banker, why our emotional decision was logical. My job and my team's job is to help provide real data to you and all of our clients so that you can make less emotional decisions and more logical decisions based on what's actually making money in ag. So with that as the foundation, we're going to get rolling here. I've got Darren Solbreck on the call as well. Darren's one of my key leaders. And a controller is the title we use for an accountant that comes in at the end of the month, and you've been entering your daily transactions. So all your bills, your credit card receipts, and charges, your invoices, those are all entered, but you need somebody to come in at the end of the month and clean it up and give you a really accurate month-end closed financial. That's what controllers do. And both Darren and Lori and Jared knows Lori well. They're some of my team that do that controller work exceptionally well. One of the things that makes LA unique is we are organized around industry instead of geography. So our goal when we work with a client is to staff their project with people that are only working in ag. Instead of having a generalist accountant that you have to teach what silage is, for example, we can match you with staff that already are deeply experienced in many cases in ag. So you don't have that frustration of paying somebody to teach them about your business. So we're going to start by talking about the best practices here. And really, the best practice in ranch financial management is these are the 7 things that we really want to see our clients have. This is what moves you from a hobby business to a real business. And this is what moves you from, and I think it's probably fair to say that many of us in agriculture like the fact that we're trying as best as we can to avoid accountability. We chafe when our banker tells us what we can and can't do. We chafe when our spouse tells us what we can and can't do, what our parents tell us what we can and can't do. And having good, in many cases, having good accounting information is not what we actually want, because then we are going to have to be accountable to what those numbers tell us. And we may lose the ability to do what we feel like doing, even if it doesn't make financial sense. So the first question I have for you is, are you ready to hold yourself accountable to financial performance in your ag business? And if you're not, there's no reason for you to pay us, because we're actually going to ask you, we're going to help you use the information we prepare to be accountable for successful management of the wealth of the land base that you own or control, as well as the operating company that sits on top of that land base. So that's the first thing that I want you to think about, and maybe even write that down if you're taking some notes. That's the first key question. Are you at a point in your life where you're ready to be accountable to yourself, to your family members, and our job is to help give you that data so that you can be accountable to a plan. And for me, I'm a visionary. I'm an entrepreneur. I hate being accountable. Earlier in my life, I would do almost anything to avoid being accountable for the financial results of the decisions that I made. Now I'm older. I got mostly gray hair now. I'm wiser, and I've learned the value of creating a system, a business that has a plan, and that I am going to hold myself accountable to performing against that plan. And part of that plan is, that's really what we mean by having an annual budget by enterprise. So if you have a cow-calf business and a stocker business and a finishing business, either grain or grass-fed, and a meat business, you have 4 different enterprises, and you may have a hay business in there too. Those are 5 different enterprises. I really want a budget and a plan for each of those enterprises that's fairly specific. So how many acres of pasture are we grazing? How many cows and calves and yearlings does that allow us to have? What's our drought plan? What percentage of our total forage production is allocated to yearlings versus cows? And the reason that's important is because we know that emotionally it's easier to sell yearlings when you're starting in a drought than it is to sell cows. So human nature says that we will always hold on to cows too long in a drought, overgraze our grass, and you're less likely to do that with yearlings. So in my opinion, one good strategy for drought mitigation is to allocate at least a third of your total forage production to yearlings, because you can manipulate the number of yearlings you have around much easier than you can cows. But I want to understand, what are your assumptions about your business, and I want to break it out. I want to break it down and figure out how much revenue is each one of those enterprises generating, and then we have to figure out how we're going to allocate those expenses. And if this isn't easy and straightforward, here's what happens: you go in to enter your bills into QuickBooks, and you think, oh, I got these 5 enterprises, I got a fuel bill. I have no idea how to split that fuel bill up. There's a million different ways I could split that fuel up. So I get stuck because I don't know how to enter it. And then it just sits and I don't get back to it. I'm going to go find something else I'd rather do than try to figure out how to allocate that fuel bill. So one of the things we're going to do with you right at the beginning is, each quarter, we're going to decide up front how we're going to split up all the different types of expenses that you have. And we need to be able to do that so you don't have to think about it for each bill. We've already decided in the first quarter of the year, I'm not doing any farming, I'm not making any hay. 90% of my fuel cost is allocated to my cow-calf herd because that's the only fuel I'm using is to feed hay. In the second quarter, it might be 50% cows, 50% cropping. In the third quarter, it's 65% cropping or hay and 35% cows. Once we decide that for a quarter, that's what we're going to use for nearly all of our expenses. The point isn't to make it perfect. The point is to make it close enough to be useful and simple enough that we don't have to think about it every time we try to enter a bill. Monthly financial review meeting with a consulting CFO. This is actually the most important one. If you commit to having a monthly financial review meeting with you, your key managers or family members, whether they're family or non-family, and an outside CFO, those meetings are going to be uncomfortable at first because you're going to be a beginner. In most cases, our farm clients, when they start working with us, they're very uncomfortable being in a situation where they have to go back to being a beginner again. This is why people don't usually learn to ski when they're in their 50s. We don't like the feeling, it's embarrassing to feel like we're a beginner and we don't know as much as we should. So the second question I'm going to ask you is, when you are faced with the discomfort of feeling like you're a beginner, what are you going to do? Are you going to run away from that, or are you going to run towards it and stay with it until you become competent at understanding how the financials in your business work and how to use your financial understanding of ag enterprises to your advantage? The good news is that financial literacy in ag is really low. So it's a massive competitive advantage if you decide to become really good at understanding the finances that are the outcome of the daily decisions you make in your operation. This financial review meeting is designed to create a scheduled event that you're committed to attending. And the point isn't to have somebody tell you what the financials are. The point is to be educated so that you fully understand the financial consequences of all the decisions that you're making. You've set some long-term goals, and our job is just to help you, give you information, and then help you use that information to make better decisions with. The number one reason that multi-generational farm families don't work is because nobody is comfortable talking about the financial aspects of the business. The parents are embarrassed and uncomfortable because they don't really know. They don't really feel like they understand it well. I mean, they understand the checkbook. They can tell you how much cash is in the checkbook, but making a 3 to 5 year plan, they don't know how to do that, and they don't really want to admit that to their kids. And so it's a topic that we just avoid. And that's really, it's not that hard to overcome this. This is not, anybody who is successful in agriculture can learn enough to understand financials. The next thing that we do is we want to give you accrual basis financials instead of cash basis financials. Cash basis simply says, in cash basis financials, you don't earn the income until you have the cash deposited in your checking account, and you didn't spend the money until the cash leaves your checking account. But that's not really how businesses operate. We have promises to get paid. If you deliver, if you sign a contract to sell a load of yearlings on Superior in October, I want to put that information. We know that you're going to sell 2 pot loads of cattle. We know roughly what they're going to weigh, and we know they may already be priced. Let's put that in as revenue, and we know roughly what the expenses are going to be. In a farming operation, the differences between cash and accrual are extreme, because if I look at a cash basis P&L for a row crop farmer for 24, I'm going to have my revenue, which is mostly my 23 sales of my 23 crop. It's going to have my 24 labor and repairs and maintenance expenses and fuel expenses. And it's going to have my 25 fertilizer, seed, and chemical. So the question I'm going to ask you as a CFO is, how much money did you make farming in 2024? And if all you have is a cash basis P&L, you can't answer that question. All you can tell me is how much your cash position changed in 24. But that's a mixture of 3 different years of operations. Well, if you want to improve your profitability, you're going to need something better than a cash basis P&L, and that is what we call accrual basis. And the accrual basis accounts for the expense in the year, in the production year. So even if you paid for your fertilizer in 23, that's a 24 expense, and it's associated with your cost of growing your crop this year. For the cattle business, we are going to recognize the revenue when we wean the calves, whether you sell them that year or not. Your cow-calf business has a P&L for 24 that has the value of those weaned calves at weaning. Even if your ranch didn't actually sell them, we're still going to recognize revenue for your cow-calf enterprise and sell those calves at that fair market value to your stock or yearling enterprise. And we're going to expense all of the costs of owning that cow for that year, for the year leading up from basically November of 23 to November of 24. All those costs are going to show up as an expense in 24. So I can tell you, did you make money or lose money running cows and weaning calves? And then the last thing we're going to do is we're going to set some goals for the cash generated by operations. The first goal we're going to set is, how much cash do you need to pull out of your business account and put in your personal account? What's that number? The second number we need to know is, how much cash needs to come out of your business account to service debt? Third question is, how much cash needs to come out of your business account to pay for your overhead? Property taxes are the big one, insurance. Those are all expenses that don't change. You can mix and match and change lots of things about your enterprises, but those 3 numbers aren't really going to change no matter what you decide to do with operationally. Once we have those 3 numbers figured out, then we can build the rest of the budget by enterprise. When we have this financial review meeting process, we're going to spend 1 to 2 hours a month. We're going to review your prior month accrual financials. We're going to review those what actually happened compared to the budget. And the budget is just all it is a collection of assumptions about your decisions, your activity. So I'm gonna run cows. I'm gonna run 500 pairs on 8,000 acres or 15,000 acres, where a lot of you guys are, or even more. And I think that I'm going to get I'm going to wean off 91%. 91% of my cows are going to wean a calf, and those calves are going to average 47% of my cow's body weight. And great. Those are some basic assumptions. If those things happen, how much will your calves be worth when you wean them? I can tell you that right now. If once we document those assumptions in your budget, now we know exactly what the financial consequences of those assumptions are. So one of the disconnects we have, if your accountant just gives you a P&L, is that doesn't help you figure out, what do I need to do different? If you don't like the number at the bottom of the P&L, what do you change? Well, you need a little more detail in your budget to say, okay, where did I miss? Where am I off track? Do I not have enough? Do I not have as many cows as I thought? Did I only wean off 82% of my cows wean a calf instead of 92%? Or did the calves only weigh 38% of those cows' body weight? One of those 3 variables is going to change. and I want to know how my actual operating performance is different than my assumptions, and thus is going to create a different P&L. The whole reason to do this is because we want to help you improve your income to stress ratio. Lots of people talk about how to make more money, but more money is not that's not actually enough information for me to decide if that's a good thing or a bad thing. Because it's just the way the world works. In most cases, in order to make more money, you have to tolerate more stress. That's just how the world works. So if you want to make more money, you can go and take on a bunch of debt and buy a neighbor's property, buy more land, lease more land. That is going to inevitably increase your stress. So for me, I evaluate both for my life and my client's life, the income divided by the total stress. And there's two ways to improve your quality of life. One is increase your income, and two is decrease your stress. And we want to evaluate every idea you have to increase income. We want to run it through a filter and ask, how much additional stress is this going to cause? And then we want to plan for the future. The one thing that nearly all of our ag clients have in common is they have a really strong desire to see their land passed on and stay in the family. And there are specific things that have to happen in order for that to be likely. If your kids grew up seeing you in a business that had a terrible income to stress ratio, it's hard to convince them that they should live the same life that they saw you live. So one of the things we have to do is we have to make a plan to make an income, to make a living and have an ag business that has an income to stress ratio that's more compelling and more attractive than alternatives that can be done in this city. All right, I talked about a little bit of this already. These are the four things to start with. This is what I need to know about your business. And my job is to create a financial management system that tells us these four things. How much money did you make from, ranching is really just turning plants into cattle weight. How much money did I make from this year's ranch production? Now, this is different than marketing because, and I want to know how much did I make turning this year's ranch production, forage, running it through a cow, and turning it into a calf that it weighs a certain amount. That's the first thing that I want to understand. Now, I may not sell that calf when I wean it. I may keep that calf and run it as a yearling. I may keep it and put it in the yard or finish it on grass, and I may sell it as a live animal to an aggregator. I may keep that animal, pay for the processing, and sell it at a farmer's market. But the first thing that I need to understand is, was I able to make money so I had more value that I created than it cost me to create it by running cows and weaning calves? And I'm going to ask these four questions from each of my enterprises. So let's just keep it really simple. I've got 400 cows and I sell weaned calves at weaning. How much did I make from marketing this year's ranch production? That is a separate question. Every ag producer, whether you're a row crop farmer or a walnut grower or a cow-calf operator, you have two very different businesses every year. One is the production of converting solar energy into something you can sell. The second one is marketing that something you can sell. And some people are really great producers and poor marketers, and vice versa. Some people are good at both. But I want to understand how much of your total income was from your marketing expertise and success versus from your production expertise and success. To answer that question, I have to set up your accounting system so that it's really easy for me to determine that. Third is, how much cash do you have now, and how much cash are you going to have in the future? We need to be able to predict the amount of cash you have and consequently the amount of debt you're going to have for the next, with pretty high accuracy, 90% accuracy for the next 18 to 24 months. And then we at least need to have some idea that that number is improving every year. And then the fourth is, what's your equity? So when we look at your balance sheet and we look at all your assets and all your liabilities, is the difference, your equity, equity is freedom. So if you value freedom, then you should also be tracking the change in that equity every quarter, at least, sometimes every month, because that tells you whether the activities you're engaging in are increasing your freedom or decreasing it. And the brutal reality is that most ag producers say they like freedom, but their actions don't support that. What they really like is freedom from any sort of accountability. And what my focus is teaching my clients that you obtain freedom by understanding and focusing on the activities that build your net worth, your equity. That's long-term freedom. To get there, you have to be willing to surrender your ability to do whatever you feel like doing today to make sure you're doing the things that improve your equity position in the future. When we get into ranch production, we're going to talk about how much did you make from this year's ranch production, turning plants into cattle. So one of the things we have to do is we have to make sure we're adjusting for inventory. So every quarter, at least, we want to take a new inventory of your stored feeds and of your cattle and your calves and make sure that we're adjusting for that. And if we don't do that, and we need to adjust for your payables as well, because if we don't make all those adjustments, we're not able to give you an accurate P&L for that period of time. In an accrual basis accounting system, we separate the date of the production activity from the timing of the payments. So in an accrual system, you wean off 300 calves that are worth $2,000 each. That revenue is earned when you wean those calves off, even if you don't sell them until January 1st, or if you sell them in December but don't take the check until January because you don't want to claim that revenue for tax purposes, that's fine. You can continue to use cash basis financials for your tax return. But I want to know, how much wealth did you create? How much revenue did you create from your weaned calves in 2024? And I want to have that show up on the same P&L as all the expenses that you incurred in order to produce those calves. When we do cash accounting, we oftentimes put the revenue in a different year from the year that we have the expenses, because what we're trying to do with cash basis accounting is maximize our expenses this year and defer our revenue to next year to defer income tax, which is great. But that does not give you enough information to successfully run your business. All right, so a marketing or a backgrounding enterprise. So if you believe you can add value to your weaned calves by keeping them, then you have another enterprise that's going to buy that ranch production, buy those calves from the cow-calf enterprise internally. So we're not going to actually write a check from one enterprise to the other, and you don't need to have multiple LLCs to do this. We can create an accounting system that recognizes inside of one LLC a cow-calf enterprise and a yearling or backgrounding enterprise and a feeding enterprise and a meat enterprise if you want. And all we have to do is decide what's the internal transfer price that the yearling enterprise pays the cow-calf enterprise for those calves. So let's say, those calves, we look at we believe that the net check we would have got for those calves was $1,900 a piece. They would have sold for 2,000, we had $100 of expenses in them to get them sold if we would have taken them to the local sale barn. All right, great. That is the revenue that we recognize for the cow-calf enterprise. That is also the cost to acquire the inventory that our yearling enterprise has. That's not an actual expense until the yearling enterprise sells those animals. It's inventory, it's an asset. And so then our yearling enterprise may have, hopefully we put a hedge on those calves if we're going to keep them as yearlings. So we've got a cost of those hedges. We've got some forward contracts. We're going to have all of our feeding costs, death loss, and all those associated costs with owning those yearlings until we sell them. All of those costs really get rolled into inventory. And we don't recognize the cost until we sell those calves. So let's say we decide we're going to keep those 300 calves. We're going to keep 100 replacement heifers back, and that gives us 200 steers and heifers we're going to run as yearlings and sell the following August. We may have a hedge, we may have a forward contract. We're going to have some way of managing market risk in our yearling enterprise, and we'll keep track of all those costs, add them on the balance sheet to the cost that we paid for the weaned calves, and those costs don't hit your P&L until you sell those yearlings the following August. So your yearling enterprise is going to recognize the additional income, hopefully, from the difference between what that calf was worth at weaning, $1,900 in my example, and what that let's say 8-weight yearling is worth the following August. And then there's going to be costs that are going to be associated with what did it cost us in order to get that, to earn that additional income. We talked a little bit about cash flow from each enterprise, how we start with an accrual enterprise P&L. We had a timing difference for collecting the income and paying the expenses. So we're not interested in when they actually hit your checkbook. We're interested in when were you obligated? When did you have an obligation that someone else had to pay you money? And when did you have an obligation to pay that? So if you've got cattle that somebody's custom feeding for you, and they're billing you 60 days after the feed was consumed, we're not going to wait. We're not necessarily going to wait and recognize that you're going to get the bill, and you know approximately what it's going to be. So we're going to put an estimate in for what that bill is going to be each month, and then when we get the actual bill, we're going to true it up. It's probably only going to be off by a few percent, and that way we're going to recognize the expense when you incurred the obligation, not when you actually wrote the check. We're going to add in the principal part of the debt service payment. So in addition to our cash flow projection from each enterprise, we also need to understand, so on an accrual basis P&L, only the interest part of your debt service shows up as an expense because you can't deduct the principal. The principal is just a reduction. The principal portion of your debt service is increasing your equity. So that doesn't show up on the P&L. We have to add that to the P&L after we come up with the net income. And then we have to figure out how much cash are you going to need for fixed asset purchases. Do you need a new side-by-side? Are you going to need a different tractor this year? Are you buying bulls? Are you increasing your cow herd by buying some bred cows? Those are all fixed asset purchases that we need to have a budget for. And finally, like I said, we want to have a pretty accurate prediction of what your cash is going to look like and your loan balance for the next 18 months. So we like to have an 18-month budget that's updated every month. So we look at our budget for last month and say, this is what we thought was going to happen to our cash. This is what actually happened. What do we need to learn from that variance between actual reality and what our budget was? Do we need to change our assumptions for the next going forward for the next 6 to 12 months based on what we learned? Are we on track with the budget or off track? And if we're off track, what are we going to do about that? Uh, you cannot, the number one way to reduce the level of stress in ranching is to invest the time with this kind of a plan. If you've used an 18-month rolling budget for 6 to 9 months and you start to believe that you can accurately predict the future, the stress level of not having cash flow surprises is enormous. The stress reduction in having a budget that you can trust is just enormous. So we talked about equity and freedom, and once we know how once we have a cash flow budget, we can tell you whether your equity is going to improve or it's going to go up or down, and how fast is it going to go up or down, for the next 3 to 5 years, maybe even 10 years out. We start with that data from the monthly cash flow statement, and then we need to understand how are we using debt? And if we're using debt to cover operating losses, we want to understand what's driving those losses. Is that a temporary loss that's due to where we are in the cattle cycle? Or is that an operating loss that's a functional problem with our business? We don't know how to run this business without generating operating losses. And if you're going to use debt to cover those kind of operating losses, sooner or later, that debt's going to get converted into a long-term mortgage against the land. And now our equity is going backwards. Now, there's times and there's lots of situations where using debt to buy something that is a great deal today that can turn a small profit into a big profit is a great thing to do. So if there's operating losses, we really want to understand why are they there? What's our plan to deal with them, and how are we going to cover them in a way that doesn't decrease our equity? The reality is ag production is a low margin, low return on assets business because we're producing commodities and all of our competitors use debt to increase the amount of total volume they can produce. And so you have to be able to use debt appropriately in order to be competitive in the marketplace. But you also have to understand when not to use debt.
Perfect. Can you talk just a little bit about that principle of equity and how when automatically our equity is going to increase when we're in an inflationary time?
Sure.
Like land prices are increasing.
Yeah.
And an upswing in the cattle cycle.
So lots of people in ag, we do this because we love it. That's what makes the cattle business unique and different from the poultry and the pig business. Nobody puts pigs in a confinement barn and goes in there and takes care of them for fun. Nobody power washes pig barns for fun. If there's not money in it, those barns are empty. Cows are different. Nearly everybody that owns cows because cows are fun. We like cows, even though they try to hurt us sometimes, and there's times that there's days that aren't fun, but overall we do it because we like it, and that makes the economics of the cow-calf industry very different than nearly any other part of ag. Price signals don't work perfectly well. And so we typically have land that's appreciating in value. And we have an operating business running cows on that land that loses money. Now those losses are great. We're not paying anything in taxes, but and one of the things that we do, and my dad does this every time we talk, he has a running tally in his head of how yes, we're losing money on our operations on horses and cattle, but look at how much our underlying land is appreciating. And we all do that because we're looking for a justification to tell us that it's okay to lose money operation. And if that works for you, shoot, my dad can afford it. He's still practicing law at 80 years old. Uh, it's not a problem for him, and so it's not a problem for me. But um, you have to find a way to cover those operating losses. And let's talk for a minute about what's driving the underlying increase in land value. And where many of you are located, if you're ranching in the west of the Missouri, the underlying land value is driven by this compulsive desire that white men who have achieved wealth in another industry have to somehow own a ranch. And it's a deeply seated, nearly unconscious drive to own land and cattle. And they have succeeded in businesses that create a lot of free cash flow for them. You can't compete with them in their ability to create free disposable income, disposable wealth that can be invested in real estate. And the kind of real estate they want is not a Amazon warehouse, even though that would probably be a much better investment. The real estate they want to buy is ranch land. And most of them are married, oftentimes more than once. And once they start looking at a ranch and their family gets involved, the scenic and recreational aspects of that ranch become very, very important. So if you are trying to ranch in an area that has scenic and recreational value, there will always be people that will pay more for your ranch than you could ever justify paying for it based on its productive capacity. So that is one of the realities of the world we live in, and we need to understand that. Now, there's some real opportunity that's created by that. If you have a core land holding in a base, there will be other ranches. Eventually ranches are going to get sold, and in all likelihood, the buyer is going to be somebody that doesn't have a history in the ranching business. They're probably going to hire a ranch manager. They're probably going to lose a lot of money for the first few years. And at some point, they're going to get tired of losing money trying to be a cattleman. And I think that there's an opportunity to do what Greg Judy has done for years in central Missouri and do it on a large scale in the West and go to those landowners if you've built a good relationship with them over time. And that means probably not, that means you gotta bite your tongue and you've got to be friendly instead of seeing them as a destroyer of our way of life. Because someday you're going to be able to go to them and say, listen, I have a hunch that what you really want from owning this land is a beautiful landscape to come, so that when you come here, it looks just very pastoral, and it's a nice mix of trees and grasslands, and it's not overgrazed, and there's cattle kind of grazing where you want them to be. I know how to create a landscape that looks like that, and I can do that at no cost to you. So instead of losing money trying to be a rancher, trying to be a cattleman, why don't you just enjoy this incredible property that you've bought for you and your kids and your grandkids, and let me lease it. And my obligation to you is I'm going to make it look and feel like the most beautiful place on earth. I'm going to make it look and feel like the kind of place that everybody in your family can't wait to spend another week there. So there's a silver lining in everything. And when we end up with the vast majority of ranch land in the West that's owned by non-ranchers, that disrupts some things, but it creates some pretty incredible opportunities to get access to land if you understand how to use animals to create a pleasing landscape to the human eye.
And so when you're talking about building equity, if I understand this right, you're not necessarily saying that we're building equity through the free quote unquote appreciation that's happening by land values. You're saying that it is reflective of our management by either increasing carrying capacity or adding value to the animals that we have.
That's correct.
Okay.
That's
Yeah.
correct. Obviously, if you own land, that land is going up in value. But if you are using that as a justification for your poor financial performance as an operator, you will not be in business. You will not own that land in 20 years. Because either somebody else will have that land, either because they made a lot of money doing something else, or because they figured out how to not need to use the increase in land value to as a source of collateral and capital to fund their ongoing operating losses. My whole point today is you have an opportunity to choose to be accountable to yourself, to your spouse, to your kids, to your grandkids, to your great grandkids, and master the skills, the financial skills that are necessary to have a cash flow positive operating business on top of the land you own. If you have land that's appreciating and you know how to have a cash flow positive operations business, and you know how to add value to neighboring land, you are in an excellent position to thrive financially and get the quality of life that you've always wanted. I mean, there's a reason all of us live in rural America. You know, this is the life we want. But for most of us, and for most of our friends and neighbors, we tell ourselves that this lifestyle is worth the stress of not making any money. It's worth the stress of having to cut expenses. And if that is absolutely true. That's true for me. I live in the country. My wife grew up on a farm. Of course, we're going to raise our kids in the country on a farm, but it doesn't have to be austere. It's possible to learn the skills necessary to create a successful business in ag, and to build not just land equity. I mean, land equity it's free money, but unless you're going to sell the land, it doesn't do any good. The only way you can leverage that equity is either get a loan against that increased value. And what are you going to do with that money? If you're going to use it to fund operating losses on your cattle business, eventually you're going to lose the land. If you're going to use it to invest in a new enterprise that is going to create permanent cash flow, positive cash flow down the road, that may be a good thing. But unless you're going to sell the land, that increase in land value doesn't help you.
Yeah, very good. You can't eat equity, sense? Right?
No.
Can't eat equity. You can't live on it forever. And I think that's one of the ways that we subsidize our businesses is through the appreciation, tapping into more equity. But at some point, appreciate you pointing. That's right. It will run out.
So I got just a few more slides here that we'll talk about. If you want to work with us, how does that work? So the first thing we want to do is make sure that we're matching you, getting you the right accounting services. And that means understanding what your goals are. So if you've got a farm or ranch under 2,000 acres and you don't have multiple generations involved, you're probably able to run it. You probably have a pretty good feel for how it's all working with just your checkbook and a tax return. You probably don't need all this extra stuff that I'm talking about. But if you have multiple generations, if you're growing quickly, if you've chosen to get bigger by taking on debt to acquire more land or more animals, so you're highly leveraged, you're running more than 3 enterprises, and you have livestock and crops together, then you're very likely to benefit tremendously from a better accounting system. First thing we're going to do is just create a ranch financial management system. So we want to start with a list of all your enterprises, figure out what your income and expenses from each of those enterprises that are easy to allocate. So if I lease yearling pasture, that's a no-brainer. That's 100% expense of my yearling enterprise. But if I'm feeding my wean calves that I'm going to run on that yearling pasture next summer, and I'm feeding my cows this winter, how do I allocate my fuel costs? Because that's shared among two enterprises. Well, we're going to help you find that simple method to allocate those shared costs between those enterprises. Second thing we're going to do is we're going to create that accrual basis budget for each one of those enterprises. So I've got 400 cows. I'm going to allocate 100 of my calves to replacement heifers, or let's say 50 of my heifers are going to go for replacement. So that's a cost that's incurred by my cow herd. The other 350 steers and heifers I'm going to keep and run as yearlings next summer. So that's my yearling enterprise. My yearling enterprise starts bearing those expenses the day that I wean those calves. Because the way I think about it is it's just like I weaned those calves from my cow-calf enterprise, sold them, and I bought them back at the sale barn as yearlings. And because that's really the choice you're making every time you don't sell an animal, is you're choosing to buy it. So now I've got a yearling enterprise and I've got a cow-calf enterprise, and I'm going to start creating a budget that lists my assumptions for each one of those. So what costs do I have in total, and which enterprise am I going to put those costs in? And we're going to adjust our accrual financials at the end of every month for our livestock inventory change, our feed inventory change, and if we're farming, our inputs. Step 3 is we're going to schedule this monthly financial review process. And I think I covered that in some detail, but we're going to get that on the calendar, and we're going to make a commitment that we're not going to miss those. We're not going to cancel them. We're not going to reschedule them. And we're going to do the work that's necessary to be prepared for them. And we're going to acknowledge that it's going to feel uncomfortable because we're going to feel like a beginner, and that is okay. That step doesn't last. You're only going to feel like that, like you're a beginner for 2 or 3 of these meetings, and that quickly goes away, and it's replaced by confidence that you're able to now accurately predict your financial future. All right, so then it's our job to figure out how to get what you need. So we start with that CFO role. Darren or Lori or I are going to meet with you every month to talk about this. And one of what we want to know is, do you have good accrual financials from the last month and from the prior year? If you don't, we'll do that for you. We'll help. We've got staff that we can bring and get involved to make sure that we're getting those accrual financials. So that's starting at the bottom of this screen. Data evaluation. This is the most important thing we do for you, and that is to evaluate the accounting information to help you understand, are you on track or off track? Are you making good decisions? If we don't have good financials to evaluate, we don't have good data, we've got to get that data right. That's what we call data verification. That's what the controller does at the end of the month. They're going to reconcile the bank account, the credit card account, your loans, your inventory, your fixed assets, to make sure that your balance sheet and your P&L are accurate, so that when we go and evaluate them, we've got good data. And then finally, the controller can't do their job if somebody hasn't entered all the daily data entry. So all the checks you've written are somebody's already entered those in QuickBooks. Your deposits are entered, credit card charges are entered. So all we have to do is make a few adjustments and clean up a few things at the end of the month. If you don't have somebody that wants to do that, or we're seeing this all the time, where mom or grandma's done the books for 40 years and nobody thought to ask her if she likes it. And it's not that expensive for us. We're pretty good at this, and most of our ag clients don't have a huge number of transactions. We can usually take that on for $1,000 or $1,500 a month. And I've had dozens of conversations where grandma's eyes light up when I put that out there. She said, "Wait a minute, you mean I don't have to do this anymore?" And everybody kind of looks at her like, "I had no idea you didn't like it." She said, "No, I hate it, but why? I mean, there's no point in complaining. Nobody else is going to do it. Somebody's got to get it done." So we want to make sure that you know that if you don't like doing it, if this is not the best use of your time, then we're happy to take that on. And everything's remote. You know, if we can get access to your bank account and see those transactions. We can put everything in QuickBooks Online. It's a cloud-based system. So it is not difficult for us to do remote accounting anymore. So we'll backfill. Some clients only need the CFO role. Most clients also need a controller, and some clients want to delegate or offload all their day-to-day bookkeeping and payroll and everything to us. So final slide. It really it takes us about 4 to 6 months once we get rolling with this to really get the financials dialed in. So we're focusing on the future instead of on the inaccuracies in the financials. Software is a tool that we use to achieve the goals, but that's not the point. We don't sell software. We sell organized financial data, and we help you to use it to run your business. We're fans of the combination of QuickBooks Online and Figured, but we're certainly comfortable using other software to achieve the same goals. Questions? Comments?
Awesome. That is perfect.
Is this what you're hoping for, Jared?
Yeah, that was really good. Yes, that was ideal. If there are any questions, you can put them in the chat. Todd's got to take off real quick to go.
Yep.
Pick my wife up at the airport,
gotta go pick my wife up at the airport. So I know Darren's on the call. He can answer any questions that you would ask. He's just as good as I am and better in many cases. Darren's the one that actually gets new clients onboarded with QuickBooks Online and Figured, or Lori. So I'm not sure if Lori's on the call, but I'm pretty sure Darren's on here. So happy to have him answer any questions you might have.
Yeah. Okay. Well, we definitely appreciate that. It looks like Darren maybe had to jump off also, but
okay.
Oh, Lori is on. Yeah, are you there, Lori?
I see Lori there.
We'll unmute and introduce you. She's figuring out the microphone. But yeah, Brittany, it was a little heavy. We get it. That's why we don't hammer on it huge in this class. And when we do it in other classes, you know, we're conscientious, we take breaks, we kind of break it up. But this is important. Remember that profitability is so critical. We can't be regenerative if we're not profitable. And a lot of times we don't even know if we're profitable or not. So that's why enterprise accounting, tracking our numbers, doing the same things. If you probably saw some correlation with what Amy suggested we do. She uses a little bit terminology in her business, but this is what she suggested in ag terms. And so way to go. We certainly appreciate it, Todd. And let's see. So the best way to get a hold of you, I'm not sure if we shared that information yet.
Sure. Let me go back. I'll put the screen up here that has contact information.
Take a screenshot of this, you guys. And again, you know, it's kind of, some of you are at that scale where I feel like you could benefit from this.
All right, can you guys see that now?
Looks like it's coming up. There we are.
Hey, who put that on there?
Okay, cool. All right, there we go. Yeah, screenshot that. And certainly you can reach out to us at Ag Steward as well if you need to get a hold of Todd. We've got contact information, email address for Todd and for Lori, and it's got it there for Darren as well. So awesome, Todd. Thank you very much.
You bet.